Tonight, we're going to talk about the balance sheet, and we're going to work so that you understand the concept of your net worth. We're going to gain familiarity with the balance sheet. I'm hoping I can make it easy for you to understand the different components of a balance sheet and how they work together. We're going to work on the ability to read the balance sheet, the ability to prepare a simple balance sheet, and to understand what assets and liabilities are, determine what your business is worth, and understanding the balance sheet and financing. With that, we mean understanding what the balance sheet is actually telling a lender about your company when you go to apply for financing. So a balance sheet in general analyzes your assets and liabilities in your company. It determines your net worth. It's also called a statement of financial position, and it provides a snapshot at a particular moment in time. We'll talk about this a little bit more as we go on, but one of the differences between the profit and loss statement and the balance sheet is the balance sheet is literally that moment in time. The minute you create another transaction, your balance sheet changes. A profit and loss summarizes a period of time, whether it be a month, a week, a quarter, or a year. So they operate in a little bit different ways, but they tie together. The balance sheet is made up of three components. The first one is the asset section. So an asset is anything your company owns that will help you earn cash or savings. It could be buildings and real estate, vehicles, inventory, raw materials, depending on what type of business you have, equipment, cash. Cash, when we say cash, means bank accounts, savings accounts, and it could be cash that you have like in your cash drawer if you're a retail business. Accounts receivable, which depends on if you have customers that you bill. Tools, furniture, and fixtures. So all of these things make up one part of the balance sheet, which is called the assets. The liability section is the obligations a company has that will cost it money, or often includes the term payable, or another way we use it, it's what you owe. Some examples are accounts payable. That would be just your general vendor bills that you have not paid up to that point. So you've purchased something, you owe a vendor for that, and you have not paid it. Taxes payable. This could be sales tax that is due. It could be your property tax, or it could be another form of like the corporate tax if you were incorporated. Wages payable. This usually doesn't happen, but some businesses may have, may pay by event, and say one event you weren't able to pay an employee. So technically you have to hold that money, and that's a liability because you owe it to the employee. Loans and notes payable, customer prepayments. Let's go back one there. Customer prepayments. And then one other one that we'll talk about more in depth is your credit cards. So your business credit card is on your balance sheet as a liability. So we already did the quick survey of the room. Do you know your business worth? And do you know the value of your business assets and the liabilities, and how much your business is worth? It's okay if you don't know this. It's in the beginning, it does seem like a concept that's a little bit abstract, But as we work through it and you start putting things down on paper, I think you're going to see how to determine this. So the first thing with the balance sheet is it's a basic formula or an equation. And it's called a balance sheet because the two sides, or the top and bottom, always need to balance. So the basic formula, the way it's written, is your assets minus your liabilities equals your net worth. So you take everything you own, you subtract what you owe, and that is your value. Of course, not everybody makes it just straightforward and easy. That formula, the way it's written, is actually how most people in the United Kingdom and Europe see a balance sheet. And of course, we flip things around to make it more interesting. So in general, the way we see it here in the United States is we say your assets are equal to your liabilities liabilities plus net worth. If you were here for our profit and loss presentation, you know that we have a sample company, which is a lemonade stand. So we're going to work through the balance sheet using the same lemon stand as our trial company. First, we're going to talk about the assets of our lemonade stand. So you probably can relate this to your business. It would be your bank account or bank accounts. Here, this one has $250. Your inventory, which could include things like cups and napkins. It could also include, if you'd had an event before and you had leftover lemons that you were storing, those would be part of your inventory. The actual stand itself is an asset that you own. And in our example today, we also own the juicer. So our total assets are $1,000. Now we're going to look at our liabilities for this company. So we still owe one of our suppliers $110 for lemons. And we did have an event a couple weeks ago, and we did not get to pay one employee, and we owe that employee $40. So our total liabilities are $150. So if we take our lemonade stand balance sheet, we will have our assets at $1,000 minus our liabilities, $150, gives us the value. Our net worth is $850. Or placing the equation in the other format, assets are $1,000, and that equals liabilities of $150 plus our net worth of $850. So that is the brief description of how the balance sheet is built. Okay, so let's say that you've been in business for a while now, and you have the opportunity to purchase another lemonade stand. Two business owners are retiring, and you've got great relationships with them, and they've offered these businesses to you for free. The question is, which one are we going to buy? So the first one is our lemonade stand, very similar to the one we already own, and it has a value of assets of $1,500. Our second opportunity is to buy this very cool lemonade van, and it has a value of $30,000. Caroline's monitoring the chat, but would everyone like to just wager a guess as to which one we may want to buy?
The van.
The van, okay. Anyone else? So I agree right now, when you look at it with the limited information we have, the van looks like a great deal. So here's where the concept of the balance sheet and understanding the actual value of the business comes in. The answer to which one to buy is really, it depends. And what it depends on is how their balance sheet looks. So let's start with the lemonade stand, and let's get a little bit more detail about each of these businesses. So the lemonade stand, with the asset of $1,500, that business has current liabilities of $200, giving it a net worth of $1,300. So that's what we would be gaining if we take on the lemonade stand. Now, if we take on the lemonade van, we know that it's valued at $30,000. But this company has liabilities of $3,500. And that does often happen when you see a business with a higher value, because they may have financed that van, for example. That's probably what's happened here. And so their liabilities can outweigh their assets, which is what's happening here. So the net worth, even though that looks like it would have been the best option, you would be taking on an additional $5,000 of debt from that purchase or free acquisition. So just with that information, the actual stand is the better choice.
Betty, can I hop in for a sec?
Yes, please.
Yeah, and so the idea, of course, is if you had the van, you might be able to do more business. There might be other things that are a part of it. So what we're describing to you really is just if you're basing it on the value and the net worth, that piece. So it is a little more complicated than that, like real life and making these decisions. But if this is what's important to look at, is the idea of the assets minus the liabilities to figure out what something is worth at that point.
That's exactly correct. And one of the ways, when you're doing the deeper dive, if you were in our class last week, you know that we could look at that van and we could say, well, what are the opportunities, the different ways that obviously it's larger, it can go different places. So the profit and loss may support that van purchase. But for this example, yes, the lemonade stand is purely from the balance sheet, the better purchase. So does anybody have any questions before I go on to our next example? Okay, and feel free to, if you have a question, pop it in the chat, or I will stop in between different examples and make sure that everybody understands where we are. Okay, so now we're going to talk about two dueling lemonade businesses. We have Lemonade Business A and Lemonade Business B. And again, we're going to look at them in terms of their balance sheet. So both of our lemonade businesses have assets of $50,000. They both have liabilities of $40,000, which means both of their net worths are $10,000. So we're going to try and figure out which one of these businesses we want to buy. We're going to look at the assets first. So in the asset part of the balance sheet, there are current assets, and that would be, for you, that would be like your bank account, your cash drawer. If you have savings accounts, that would be a current asset. It's basically anything that you expect either to be cash, like cash in the bank, or could turn into cash within a year. So that would also include if you're a business that invoices your customer and you have terms of net 30, you would expect that that would be paid within the year. We also have fixed assets. Fixed assets are longer term purchases. This is where you would have something that's the useful life of it is more than a year. And here's just a little chart to give you some ideas. So under assets, when you're building your chart of accounts for your assets, you would have cash and cash equivalents, your receivables, your inventory is a current asset because you are expecting that you're going to use that and replenish it throughout the year. And then your fixed assets would be property or equipment or vehicles. Also on the balance sheet, we need to break down our liabilities, just like we did our assets. So we have current liabilities, which is a company's debts or obligations that are due within the year of a normal operating cycle. And we have long-term liabilities, which are debts that are longer than a year. So this would be perhaps a loan on a vehicle. And here is what the chart of accounts may look like, a simple chart of accounts for the liabilities. You would have your accounts payable, you're under current liabilities, those need to be paid. Customer prepayments that you're holding until you fulfill the order. Your business credit card balance, any salaries that are payable, and then a current portion of long-term debt. And what that means is if you had a financing on your Lemonade van, you would want to figure out what principal of that financing plan was due in the current year. That would be the current portion of long-term debt, and then the balance of it would be under long-term debt. And then taxes payable, usually that's sales tax for small businesses or property taxes. And then under long-term liabilities, there's long-term debt and deferred taxes. So I think the easiest example there is to use property tax as an example. That's usually made in 2 payments. You're making one payment in November, and then the second payment isn't due until March of the following year. So the deferred amount that you had not paid would be sitting on your balance sheet as a long-term liability. So back to our dueling lemonade businesses, which we, at this point, they look the same, except for the colors and the lemon on top of one van, but their balance sheet looks the same. So now we're going to go through an exercise and assess their assets and their liabilities. So let's look at Lemonade Truck A. Lemonade Truck A has cash of $16,000, inventory on hand of $1,000, accounts receivable $3,000. The truck is worth $30,000 for a total of $50,000. Their liabilities are their payables at $10,000, the current portion of debt at $5,000, the long-term debt at $25,000 for a total of $40,000. So that is Lemonade Truck A. Lemonade Truck B. Let's look at their assets. They have $8,000 in the bank, $1,000 in inventory, $2,000 in receivables, and their truck has that cool lemon on the top, the sign, so it's worth $40,000, giving them $50,000 in assets. The liabilities are accounts payable $5,000, current portion of debt is $10,000, long-term debt is $25,000 for a total of $40,000. So now we're going to do a little bit of a comparison to see which is in better shape. The first thing we're going to do to analyze that is really look at the current assets and current liabilities. And the reason we do that first is that is the money you have on hand and the debt that you owe in a current period. So we want to make sure that when you're looking at a business, that they have enough money to handle their current debt. So when we look at Lemonade Truck A, we can see that their current assets are $20,000 and their current liabilities are $15,000. So that looks good. They have enough cash. If they don't make any more sales, they can pay their current debts. When we look at Lemonade Truck B, their current assets are $11,000 and their current liabilities are 15. So they are in a little bit more dangerous position as a business because unless they increase their cash, they do not have enough money on hand to cover their liabilities. So they're a little bit upside down. So you can see we're saying Lemonade Truck A is in better shape than Lemonade Truck B. So does anybody have any questions there? Okay. So here we are, we've got our same dueling lemonade businesses, just a reminder of how much they look alike, but we've seen by digging down into their balance sheet that they actually are not the same. Lemonade Truck A is financially better off than Lemonade Truck B. Okay, let's take a little break for a minute. And does anybody have any questions about this section and how you look at your current assets, how you would sit down and take a summary of your bank balances, money that people owe you, inventory that you have on hand, and then also take a look at the money you owe.
And to just sort of repeat back what Betty has given us is that we started with the idea of assets minus liabilities. And if you haven't done that yet, if that's your starting point, that's a great place to start. And what we're trying to show you is that there are details. People say the devil is in the details, but there are some additional details that tell us more about businesses. And that's what we're trying to do is we're adding on a little bit of that detail and sophistication as we go through. And so that's, you can see it does matter. What is your current part of your assets and your current part of your liabilities. And those of us who, again, on the lending side, we look at these types of things as well. And we'd like you to understand them also. So we're just sort of building on a little bit. Wherever your starting point is great. And whatever detail, whatever is sort of the next level of detail that you can add, it's going to give you more information about your business that's going to help you run that business and make business decisions.
Thanks, Danny. Okay, are there any questions? Just one more double check.
Not seeing any in the chat.
Okay, great. All right, so back to our dueling lemonade businesses. And we're going to just dive in a little deeper and look at them in more detail. So we know here we have Lemonade Business A and Lemonade Business, oops, let me get them up there. Okay, get that all up there for you. So we have Lemonade Business A and Lemonade Business B. We've got their current assets, fixed assets. We've got their total assets, current liabilities, long-term liabilities, total liabilities, and the net worth of $10,000. So these are two other lemonade trucks that look the same at the moment. And we're trying to figure out which one to buy. So as we saw in our first example, it's a little deceiving when they look the same. You need more information. And that is what the financial statements give you. So one of the things we want to figure out what it is that affects a business's net worth. And we've been talking about that a little bit on the current side, but now we're going to dive a little deeper. So one things that changes your net worth is if you were to get money from the magic money tree, obviously you would be increasing your net worth. But we know there isn't really a magic money tree. If your business earns more profit, that increases your net worth. And we'll dive into that section of the balance sheet in a little bit. Or if people, which could be you as an owner, or maybe you have someone invest in your business and you're able to make like a cash infusion to the business, give money or give an item to the business that increases its worth. And then when we're looking at what causes a business's net worth to decrease, well, if your business loses money, that obviously is a decrease, and a business loss would be a reflection of your profit and loss. So that would mean on your profit and loss, your expenses exceed or they're higher than, they could exceed your revenue, or they could just be larger, larger than what maybe you would like them to be. And you would decrease your net worth if you give money or something away. And for many of you, that if you're running a small business, it's an LLC, you're not really taking a paycheck, but you're taking a draw. And so when you pull money out of your business, it reflects on the balance sheet. And so it does lower your overall equity. So the third section of the balance sheet, and we talked about the chart of accounts when we were talking about the profit and loss statement. And in that segment, we talked about, well, here's your chart of accounts for income. Here's your chart of accounts for expenses. When we talk about the balance sheet, we're adding to that. And we're saying you have a chart of accounts for your assets, which we've reviewed tonight, a chart of accounts for your liabilities. And now we need to talk about what that categories or what the chart of account portion of equity looks like on a balance sheet. And we split it up because we've split the presentation up and talk about them in segments. But really, a chart of accounts is a combination of all of those. So it starts with your assets, and then it lists your liability section. Then it has your equity section, your income section, and your expense section. And that makes a full chart of accounts. So when we're talking about the owner's equity, up to this point, all we've talked about is the fact that assets minus your liabilities gives you your equity. But equity has many parts to it. And when you start out with a balance sheet, it's completely okay to just have equity, an equity section. But as you become more sophisticated and as you work in your business longer, it will help you if you break out your equity into at least these areas that are on the screen now. So you would have the net profit, and what that means is a net profit of where you are at that point in time. And most people look at their balance sheet and profit and loss when they're comparing this part. It's usually at the end of a specific time. So like you're wanting to know what your net profit was for the year. Retained earnings, which we're going to do some samples here, is a combination of the profits and losses that have happened in your business over the course of your business. So in the first year, if you made $500, and then the second year, you're going to list that year's profit under net profit, and then the $500 will drop down into your retained earnings. You would have your contributions by owner. So that would be you if you took money from your personal savings, put it into the business for whatever you needed it for. That would be a contribution by the owner. And then as an owner, you could also make a non-cash contribution. And that, an example of that would be like in the lemonade stand, if you personally bought a super duper juicer, and then you want to put that in the business, you're going to record it as an asset. And then the offset is going to be the contribution by you in the non-cash section. And then the drawdown by owners would be money that you take out of the business as the business does well. That's a way of paying yourself. So when the business earns more profit or loses money, then the effect is on the net profit and the retained earnings. When people give money, either you or an investor gives money or a non-cash item to the business, then it's affecting these two areas, the contribution by owner cash and the contribution by owner non-cash. And then the last one is when you take money out of the business to pay yourself, that's a draw, and that is going to affect the drawdown by owner, or on a lot of balance sheets, it's just called a draw, owner's draw. So now we're going to go into this section and learn how to understand what net profit is and what retained earnings are. And I actually think, you know, when it comes to understanding a balance sheet, I think this is one of the areas that is the most difficult. So I think if you can look at this sample that we're going to work through, and we're going to work through a few of them, I think it'll help you understand the difference. One of the things that you'll find out as your business grows and when you start working with an accountant, there's a pretty hard and fast rule that as a business owner, you don't change retained earnings without it being a result of what's going on in the business. So it's not a number that you just go in and change. It is a summary of what's going on. So the net profit for the most recent period. All right, so we're gonna take this little example right now. So we have company A. The company's been in business for 4 years. The company averages $50,000 net profit in the first 3 years, and then it earns $60,000 in year 4. So the balance sheet for year 4, when year 4 is over, on the balance sheet, the net profit is going to be $60,000, where just above it told you that it earned $60,000 in that 4th year. The retained earnings is $150,000. And the way we got that is we know the business has been in business for 4 years. Retained earnings is summarizing the 3 years prior, and the net profit is the $60,000. Hang on just a sec here. Thank you. Okay, so the balance sheet, so we have the net profit at $60,000 and the retained earnings are $150,000. So the retained earnings are a combination of all the prior net profit from previous periods. If your business had a loss, that would also change the retained earnings. So it would just reduce the retained earnings. Now we have company A on year 5. So in year 5, company A earns $75,000 in profit. So the balance sheet for year 5, the net profit is $75,000. And now we're going to figure out the retained earnings. So does anybody have a guess of the retained earnings here?
Go, Melissa. I know Melissa wants to do this.
Come on, Melissa. I guess she doesn't.
I have kids, and so I'm afraid they're gonna like run in and just scream. So I've been muting myself. I was just gonna throw out 200,000. That's all I was gonna say. I wasn't gonna do it mathematically.
Okay, so that's close. Mathematically, though, it would be the 60,000 plus the 150. So you want to summarize the 4 years prior for year 5. So $210,000. So is that, does everybody feel comfortable with that concept? Okay. So
You're gonna take silence as a stent. I can tell.
I do.
That's good. All right, that's fair.
If you don't understand, just say yes and just say, and we'll back up, because that's one thing that's great about PowerPoint. You can go forward and backwards. So generally, we break down the owner's equity because it gives you a better idea. It gives you a better idea how the business has gotten to where it is today. For example, if we only knew about the assets and liabilities, that's just a small part. But if we were looking to buy the business, we might want to really see how much the business has made in net profit. The retained earnings gives you an idea of how profitable it has been over multiple years. Owner's contributions let you know how much money the owner has put into the business. And then the draw lets you know what the owner has taken out of the business. So it just gives you a clearer picture of your business and how it's operating. So you learn, as I said, profitability of the company over time, owner's personal investment, and how the owner is using their earnings. So you can leave the money in, reinvesting in your company, or you can take money out because you're paying yourself. All right, so back to our Dueling Lemonade business. So we know that the net worth of our Dueling Lemonades is $10,000. And we're going to do another comparison. So comparing competing lemonade stands that have both been operating 4 years and both owners work half-time in their lemonade stand. We have business A on the left and business B on the right. They both have a net worth of $10,000. Now we're going to start building the equity section of the net worth. So business A had a net profit in the current year of $2,000. The retained earnings are $5,000. So when we look up at the top and we know the business has been in business for 4 years, then the retained earnings is telling us that over the course of the 4 years, there was $5,000. The owner has put $10,000 of their money into the business. And over the 4 years, the owner has taken out $7,000. Now we're going to look at business B. Business B has a net profit of $25,000. The retained earnings are $75,000. So again, that's a combination of all of their profit and loss, if there was losses, of the 4 years prior to the year you're looking at on the balance sheet. Here, the owner has put in $10,000 also, but they've made a lot more money, and so they've taken $100,000 out of the business. So you can see the equity section actually gives you a lot more information. There are $10,000 for A and $10,000 for B looks the same. But when you add the detail of what's going on in your business, you can see that business B has done a lot more business. And there we have it, our big red X showing you that actually business B is the one that has had more profit. So in talking about the balance sheet and just kind of a summary of what that piece of the financial statement is doing for you, you need to remember that it's a snapshot of the company at one moment. Usually, when you're presenting it, it would be at the end of a specific period, but it changes every day you're in your books. It determines your net worth. It is the document that you're recording all your assets on, and you're recording your liabilities and determining your net worth. You're using the balance sheet to do that. It assesses what the company owns and owes. It'll show trends over time. And what that means is if you're doing your balance sheet on paper, which is fine, or in Excel, then you can save the balance sheet from like the end of 2022. And then when you get to the end of 2023, you have your balance sheet has been continuing, and now you can compare the two balance sheets. This is something that I think it's a good practice for you to follow. I do it a lot when I'm looking at people's balance sheets. I like to see what's going on with in particular, their cash, and see if their liabilities have changed. Have they really taken on a lot more debt in that next period? Or have they been able to maintain a cash flow that is similar? So that is something that we would be looking at. And as Danny said, the devil is in the details. So getting it all down and into the document will help you understand your business. And it can help you get financing. So when we're talking about getting financing, it's just like what I was saying just a few minutes ago, where being able to show a lender that you've been able to maintain your cash flow, that you haven't taken on an extreme amount of debt, and your net worth, along with your profit and loss, really gives that lender the documents they need to determine if they are going to issue you financing. And it can be a really very simple document. You can do that on paper or in Excel. We will talk too about using an accounting program, but if you're just beginning, there's nothing wrong with creating it on paper or in Excel. One of the things that I have done in the past when I teach people to set up their businesses in an accounting software is I always say it's a great idea to sort of think of your business as a file cabinet. And make sure that you understand what's going into every file and what information you need in that file. And it'll help you set up the sections of your chart of accounts, whether it be manually or in accounting software. So we'll take another minute and see if there are any questions or if there's anything else that Danny wants to add.
Look, you're just inviting me in now. That's great.
And I needed a drink, so.
Well, I will say sometimes, people focus on profit and loss, obviously. I mean, businesses, people talk about profitability and those things. And a profit and loss statement is generally tells you how well you're doing day to day, how well your business is doing. The balance sheet says more about how well you run the business over time, quite honestly. How it's where a lot of sort of like the structure and the foundation of the business is. And that's why, whether it's stock market or other things, people talk about how much a company is worth, because your profit and loss is really a tool that builds your balance sheet, builds your net worth and the assets. So even though we don't focus in general as much, people don't always focus on it, it's incredibly important to at least, again, start doing part of what these classes are about is encouraging people to start doing the basics. And then again, no matter what level you're at, no matter what level of detail you are capturing, and if it's an accountant who's capturing it for you, that's fine too, or a bookkeeper. We want you to understand what it is that they're presenting to you and how to basically read and understand. And it's your business. The idea is we want you to know everything you can. We want you to know your business. They say like inside and out, and this is part of getting to do that. So yeah, how's that?
Thank you. That's perfect. Thank you. So now we have another sample business. We're going to visit All Things Fermented. So this sample business is a producer of fermented foods, and they sell wholesale online and at farmers markets, and they've been in business for 3 years. So we're going to use All Things Fermented's balance sheet. This is just one that's already been created so that we can talk through and sort of learn what we're looking for. With pulling it all together. We've been talking about it in chunks, and now we're going to talk about it together. So question 1 is, what time period is covered on the balance sheet? So we go back to our balance sheet, and we're going to look for the time period. Does anybody have an idea what the time period is? Anyone want to throw it out there? All right, well, I'll click and let the circle tell you. So this is the balance sheet on December 31st. So it's not summarizing a period, it's the actual point in time, December 31st. And it's the date, not a time period. Question number 2. Is the balance sheet balanced? So this is something that everyone's going to look for, and it is easy to get. You can get out of balance, so you want to do your best to stay in balance. And is this balance sheet balanced? Well, we have our assets of $10,000 in fixed and $3,600 in current, so $13,600. And then we're going to look at our liabilities, which are underlined there, the $4,550, and our equity, $9,050. And yes, we are in balance. $13,600 is the assets, and then we add our liabilities and our equity together, and we are in balance. Now we're going to talk about what All Things Fermented ratio is. And that is talking about the ratio of your assets to your liabilities. So the current ratio is current assets divided by current liabilities. As we've said, we know where our current assets are. There we go, $3,600. We know our current liabilities, $2,250. So when you take the 3,600 divided by 2,250, you get 1.6. That means for every dollar that you owe, you have $1.6 to pay it off. So ATF has been in operation for 3 years. Now we want to know in its first 2 years, on average, did All Things Fermented make more money in its first 2 years or in the current year or most recent year that the balance sheet is capturing? So here we are looking at the balance sheet again. And we're going to look in the equity section where we talked about giving more detail so that you can understand what your equity is. So we know here the retained earnings are $750. And we've been told that All Things Fermented has been in business for 3 years. So $750 is capturing the first 2 years of business. So we're saying that's an average of $350 a year. 350, yeah, a year. The net profit for our current year is $477.20. So using the balance sheet, we can see that the business has done better this year than it did in its first 2. So the business is growing. And so the answer is its most recent year is when the business did its best. Now, the other thing we want to make sure is that the net profit on the balance sheet aligns with your profit and loss. And this is something that you always want to check and make sure that you have the 2 documents working together. So here we have All Things Fermented, again, their balance sheet. And we know we're going to note the date, which it's December 31st, 2019. We're going to find the net profit, which we've already done once. So we're going to look at that again, $477.20. So there's your balance sheet number. Now we have All Things Fermented profit and loss. So like we learned last week, the profit and loss summarizes a period. And so let's note the time period. This is a full year. Now we're going to find the net profit, which is on the profit and loss, is your revenues less cost of goods, less expenses. And there we have the $477.20. So that is how these 2 documents tie together. Your profit and profit, income or loss at the bottom of your P&L should be the same number that you find in the equity section for the profit on that specific date. So are there any questions on this part?
I'm not seeing anything in the chat.
You're not? Okay, thank you. Okay. So, yes, we know they match. Okay, there you go. So now we're going to think about what a lender might focus on when they look at All Things Fermented's balance sheet. So we've got their balance sheet back up here, and we have said that we're going to try and figure out what a lender might look at. So one of the things the lender's going to look at is what their assets are and existing debt. That's the balance sheet gives both of those answers to the lender. The lender can see by looking at the retained earnings if the company has been historically profitable. And the lender can see what the business owner has added to the business, the contributions from the business owner. And it can tell if the profit and loss on the balance sheet ties to the profit and loss statement, because you would be presenting both to someone, to a lender. Okay, so this is a little bit of a repeat here, just to kind of remind you that when you're getting ready to set up your financial statements, there are a couple things you should do first. And the first one is, it's really to your advantage to have a business bank account. And if you're going to use a credit card, to have a business credit card. It will make your life so much easier because you aren't mingling your personal expenses or maybe income that you received from another business that you have, or a gift you received, or W-2 income in with this particular business. And you want to organize your data. And that is just like we talked about, the process of making your chart of accounts. That is organizing. So we're going to analyze your assets. So you're going to create buckets for your assets. And here would be how you would maybe just look at that very simply. You want to know you have your bank accounts or cash, your accounts receivable, you have some equipment, maybe you own a building, you have inventory for your business, and perhaps you have a vehicle in your business. Then you want to build the chart of accounts, you want to sort these into current or fixed. So we can do that now. And as you remember, when we were talking about the difference between current and fixed, current assets are what you would use in a year, and fixed would be a longer term asset. Okay, so our cash is current. Accounts receivable, we're going to collect that money. That's current. Our equipment is much more expensive, and so that's a fixed asset. We're going to hold on to that. The building would obviously be fixed and more expensive. Our inventory is a current, and we hopefully are going to use our oldest inventory first, and our newer inventory will go in to be the backup. And then your vehicle is fixed. So there's your first part of organizing your chart of accounts. Now we can do the same thing for the liabilities. You analyze your liabilities, you create your buckets. We have our buckets here: accounts payable, all the bills that you have that have not been paid, customer prepayments that you're holding until their order is ready, gift cards, long-term debt, wages and payables, and current portion of long-term debt. And then, as I said, this is where your credit card would go also. And again, we know we need to pay those bills. Current customer prepayments, we're going to wrap that sale up within a year. Gift cards are going to get redeemed. Long-term debt, so the debt that's not due this year on your building, your car, or a loan that you've received from a lender long-term. Wages payable, you need to get those wages paid. And then the portion of that loan that would be due in the current year is current portion of long-term debt. So now we have two parts of our balance sheet organized. And now we'll analyze our equity. Same process. You are going to create your buckets. So you have your owner's contribution, cash, owner's contributions, non-cash, your net profit, which you're pulling off of your P&L, your retained earnings, which is a summary of your profit and loss over all of the years that you've been in business, and your owner's draw, which is the money that you are taking out of the business. And there you have it. You have a chart of accounts for equity. You would do the same thing, which Danny talked about last week, when you're doing your income and doing your expenses. So you're summarizing the different types of income that you are going to earn, and then categorizing all of the different expenses that you will have in your business. So from there, you need to decide how you're going to track this. So you can use a calculator, paper and pencils. I've seen people do this in envelopes. The first accounting software I ever used was actually called Shoebox Accountant. And that it really helped me to think about that. You just put it into the envelope or your bucket, your category. You can keep track on the outside of the envelope of how much is in that category. You can use a spreadsheet like Excel. That'll do the calculations for you. You can make it interactive. You can use formulas. It just depends on your skill level, but you can do quite a bit in Excel with simple formulas and keep track of what's going on in your business. Or you can use an accounting software. Here we're talking about Wave and QuickBooks. There's Zoho Books, there's FreshBooks. There are a lot of different kinds of accounting softwares that you can use. Some are softwares that actually are installed on your desktop. Those are actually becoming harder and harder to find. So many of the accounting programs now are in the cloud or online. Okay, so we've talked about, we're going to create our categories and our chart of accounts. We're going to take inventory. If you have all your inventory in your storeroom, you have to take inventory and know the value of it to be able to put a figure into your books. You determine the value of your assets and your liabilities, and you use the purchase value on the balance sheet. You determine the current portion of long-term debt, and you create and modify the balance sheet with all of this information. So if you had everything just in envelopes, what you're really doing is creating the document that summarizes all of those envelopes. Same thing with Excel. If you're using a column and you're tracking all of your ins and out into your bank account, then you're going to use that summary of your bank account to create that section of your balance sheet. And then your equity is, as we said, assets minus liabilities. That's the simplest version. So back to our lemonade truck.
Betty, could I just know for a quick second? I think Patty has her hand raised. Patty.
I just wanted to know if there's a fee to the software, to the other programs that you mentioned, other than, and not Danny's tactic, the back of the napkin, not recommended.
That is, yes, we do talk about that here in a little bit more. We go over the pros and cons. So that is
Perfect.
coming up.
Thank
But yes,
you.
most of them do have a fee. So. Okay, so. Again, this is just where we got to, but you've seen this document already. So this is ultimately what you would be creating. This is just a template that we can make available for you. And it's a worksheet that you can work through to figure out a balance sheet. So we will make the link for this available to you. So on the paper method, again, we're determining the cash and non-cash for equity, our most recent net profit, determining our retained earnings, which is the summary of the years before the current year, determine what the owners have taken out of the business, and that is the equity section.
Looks like
So,
oh, sorry, we have another
yeah, go ahead.
question, I think. From Nagi. Go ahead and go ahead and unmute.
Okay, I was asking because I'm listening, but I'm not as keen in as last week, and I'm not very good at these things. So we will be getting the recording like last week also, so I can take my
Yes,
time to go
yes.
over it. All right, thank you
Yes,
so
so
much.
then you'll have it and you'll be able to refer back and go through it a little slower. Yes.
And sometimes too, it's hard when you're starting a business because you have to do it all yourself. If you can do well and this isn't your thing, quite honestly, that's why we have people like Betty, who we have people who are experts who help us at it. I'm familiar with these things, but Betty is like our expert. So Nadia, I just want you to know that if that's something that this isn't quite your thing, like we just want you to be able to understand it, even if you get an expert to help you out with it. But understand that's also something you can do.
Yeah, absolutely. Absolutely. So, okay, sometimes your balance sheet doesn't balance. And usually this happens when you are manually creating your balance sheet. So if your balance, you want to recall that your total equity equals your assets minus your liabilities. And we're going to try and figure out why we don't balance. One of the things that is really helpful when your balance sheet doesn't balance is that if you're the one who's been keeping track of everything in your business, you probably have the best opportunity to understand where the mistake is. So you're either going to have to increase or decrease one side of the balance sheet or the other. So that could involve your owner's contribution. It could involve your retained earnings, or it could do the opposite and affect your owner's draw. So let's look here at this balance sheet. This balance sheet is currently out of balance. As you can see, we have total assets of $49,000. If we add the liabilities of $39,000 and the negative owner's equity of $15,000, it says our total liabilities and equity are $24,000. So we are not in balance. When this happens, if I were looking at this myself, the first thing I would do is I would be going back and double checking that, yes, in fact, 15,000 is what I have in the bank. You know, yes, in fact, my receivables. I would be looking at each of these numbers. And on the liability side, I would be double checking that The current liabilities and the long-term debt are the correct numbers. Oftentimes the mistake is down in owner's equity. And so you can see right here, we're at -15. To get to 49,000, we really needed this number to be a positive $10,000. So 39 plus the 10 would have given us the 49. To get to that positive 10, we're off by $25,000. So it could be that you calculated your retained earnings wrong, or you've listed the draw wrong. So that is what you're doing. It's a little tedious, and this usually only happens when you are working in either a paper or Excel. So once you figure out that you're balanced, then how do you stay balanced? The easiest way to stay balanced, honestly, is what we've just talked about here, where you go through and you double check your work, double check that your numbers are matching what you think they should. So you're looking for either that $10,000 on the asset side, or possibly if you put that there, then you're at 60. So now you're out of balance again. You're at 60 and 50. So you're unbalanced. Now you can do the same exercise. You're like, okay, well, I got to find $10,000 more on my liability side. So same thing, you're looking at your contributions. Did you put 20,000? Is that supposed to be 20,000? That would bring you into balance. So it's a game of actually going back and looking at what you did. And that is, as the owner, you're probably the only one who's going to be able to find that, in a hand done balance sheet. These are just some more here. Let me just get past this. Okay, so at the end of the exercise, you want to make sure that you're balanced. So it's 10 adding to one side or subtracting to the other, getting yourself in and out of balance. I think this is a repeat slide. Sorry, hang on there. Okay, once I'm balanced, how do I stay balanced? So this is what we were just talking about. You're going to look at both sides and try and figure out where your problem is, and then you're going to make a change either to one side to reverse it or the other. So now, as Patty asked, when you're deciding if you're going to use accounting software, yes, they do have fees. They vary a lot. So you do need to do some research on that. The pros of it, for sure, is that you don't have to set up the formula or the math. So you don't have to worry that you've got that formula incorrect. It's the easiest way to protect yourself from getting out of balance, because the software knows when you take money out of your checking account to buy something, it knows what to do on the other side. It makes it really easy to generate reports. The reports, like the balance sheet and profit and loss, are all built into even the simplest accounting software. And it's good at handling volume. So as you get bigger, it's something that you should consider, because it'll free up your time for other things that you need to do in your business. The cons are it does cost money. There's a learning curve, and you may need training. Most of the accounting softwares come with sample companies where you can go in and play with the software and really learn it. And I have always found that using a sample company and just doing some practice things is one of the best ways to learn how to use the product. sometimes the initial setup is difficult, but if you have been keeping your books in a spreadsheet or by hand, you've actually done a lot of the setup already. So you know what your assets are, you know what your liabilities are, and we've talked about the different sections of equity. You have your handwritten profit and loss, so you know your revenue categories and you know your expense categories. So although it says it's a difficult initial setup, if you've already been working with your books, I don't find that it's not unmanageable. Data may be hard to extract. I think that that's just a personal opinion, and it's relates to how much you understand the software. So one of the things, this is an example of that. Danny and I work a lot where we're looking at the profit and loss, and it's for a whole year. And let's say we're looking at advertising, and Danny says, well, I want to know what's in that number. You know, we've got $10,000 in advertising. What did we spend it on? So if you are keeping it on paper or in your envelope, you would just pull out all those receipts, or you'd have the list on paper. When you go to accounting software, you just need to have the skill to know that you can click on that $10,000 and the software will bring up another window. It's going to drill down and give you more detail. And then in that detail, you can drill down. So it isn't hard to extract once you have the skill, but you do have to acquire the skill to be able to extract the data.
Hey, Betty.
Yes.
Actually, I think you're going to answer the question. Someone asked in the chat, what is the name of the accounting software? So it looks like you're going to answer that right now.
Yes. So here are some of the ones that are current right now that you can find information on fairly easily. I know a lot. I personally work in QuickBooks. That's been my accounting software for my whole career. But I have worked with businesses that have set their books up in Zoho and FreshBooks. They have found it very easy to use. I think if you are comfortable on the web and comfortable on a computer, you would be comfortable with any of the software that's listed up there. QuickBooks is by far becoming the most expensive. And they are eliminating their desktop version. So they have a high subscription rate and a high renewal rate. But that said, for some businesses, it's still the best choice. Accountants use it all the time, so it's easy to integrate with your accountant. It has more robust features than some of the other ones. But if you're just starting out and you want to put your business into an accounting software, Wave, Zoho, FreshBooks, I think that you would find all of them could meet your needs.
I would also add, just real quick on that, that some software have slightly different price tiers, and some are actually kind of geared towards small businesses. So that's something to keep in mind, is that there might be certain software companies that are trying to provide products that are specific for small businesses in terms of the types of uses that they have, but also the pricing might be a little bit more appealing. So that's just something to keep in mind as well.
Yeah, thanks for pointing that out, Eugene. And the other thing that a lot of the software companies do is within the brand, you can buy different versions. So you can have a basic version, a premier version, a professional version, an accountant version. So you can always start at the most basic and then upgrade. So the process for purchasing an accounting software would be to explore the software features and the prices. Desktop browser versus app. And as I said, desktop versions are becoming more difficult to find. Making sure you have your chart of accounts ready to enter and set up. And another thing that's really nice about using software is as you get more comfortable with it, you can link and import information directly from your bank account and from your credit card. There are some risks to this because if you make a mistake, you have a pretty big mess to clean up. But if you take your time and do a practice in a practice company and make sure you understand and I say take time to actually take a breath and look at everything before you get ready to import. It's telling you what it's going to send into the software, and you need to just make sure that it's what you want. You want all the transactions from last month. You don't want all the transactions in the account. So the bank feed is going to ask you questions, and you just need to really pay attention to that. The software will log additional transactions for journal, so you can do journal entries for assets, owner's contribution. So that it has functions that will work more in terms of accounting in general. So are there any other questions right now? Are there any in the chat, Eugene?
Nope. No questions in the chat.
So I wanted to give you our contact information. Like I said, I'm Betty. Danny's the one who's been adding commentary for me. We're both here in Tucson, and there's our phone numbers and our email contacts. So we'll make sure that the recording is available for you so you can go through it at a slower pace. And hopefully the slides will help you understand how to take what is in the slide and make it relevant to your individual business and your needs. Danny, did you have anything else?